Welcome back to Wealth Unlocked. Today we're talking about the biggest investing story of 2026 that almost nobody is explaining correctly. Active ETFs now account for 80% of new ETF launches this year. Active ETF assets have crossed $1.47 trillion, growing at a 59% compound annual rate over the last 3 years. $459 billion in net new flows last year alone. If you've seen the headlines, it looks like active management is making a comeback. Repackaged, rebranded, and ready to take on the index funds. And on the surface, it's a compelling story. But as you're about to see, the data tells a much more interesting tale. And for most investors, the default answer about passive versus active hasn't changed at all. What has changed is how easy it is to be confused by the packaging. Let me start with a number that should stop you cold. 94%. That's the percentage of actively managed US stock funds that underperformed their benchmark over a 20-year period, according to the SPIVA scorecard from S&P Dow Jones Indices. This is the gold standard of active performance measurement. It's been running since 2002, and it controls for survivorship bias, meaning it accounts for the funds that failed and disappeared from the data, which makes the survivors look better than they actually are. 94%, across every US equity category, over every meaningful time horizon longer than a few years, the majority of active fund managers have failed to beat the simple index. Not by a little in some years and a lot in others. Consistently, decade after decade, Morningstar's active/passive barometer, their semi-annual report covering $26 trillion in fund assets, tells the same story. In 2025, only 38% of active funds survived and outperformed their average passive peer. Over 10 years through 2025, roughly 1 in 5 active funds beat the passive alternative. And this isn't an indictment of bad managers, it's a structural reality. All active managers together are the market. Before fees and trading costs, their average return is the market return. After fees and trading costs, their average return is below the market return. It's arithmetic, not opinion. So if the base rates are this clear, why is there a $1 trillion surge in active ETFs? This is the question that most articles get wrong. They see the flow numbers and they conclude that active is making a comeback. But the real driver is migration, not conversion. The active ETF surge is happening because investors who already preferred active management, people who believed in stock picking, who had active mutual funds in their portfolios for years, are switching those holdings into active ETFs. Same managers, same strategies, better wrapper. And when you understand this, the entire narrative about active making a comeback shifts from a story about performance to a story about product structure. Let me explain the tax difference because it's genuinely important. When an active mutual fund manager sells a stock that has gone up, that gain gets distributed to all fund shareholders as a capital gains distribution, even if you never sold a single share. You owe taxes on it that year. The average actively managed mutual fund distributes capital gains equal to roughly 53% of its net asset value over a given period. Compare that to ETFs, which use an in-kind creation and redemption mechanism that allows them to avoid realizing most capital gains internally. The average ETF distribution rate is around 9%. So if you hold an active mutual fund in a taxable account for 10 years, you're paying taxes on gains you never realized year after year. Move that same money to an active ETF with the same manager and strategy, and your tax bill drops dramatically. That's not a vote for active management, that's a vote for the ETF wrapper. Think about it this way. An active mutual fund that trades frequently generates capital gains distributions for its shareholders. You might hold the fund for 10 years, never selling a share, and still get hit with a taxable event every year because the manager sold positions inside the fund. The capital gains distribution gap between ETFs and mutual funds is enormous. Roughly 9% average distribution rate for ETFs versus 53% for actively managed mutual funds. So if you're an active management believer with a taxable brokerage account, moving from an active mutual fund to an active ETF is a no-brainer. Same exposure, much better tax treatment, No change in your conviction about active versus passive. The dollar amounts flowing into active ETFs reflect this migration far more than they reflect a shift in the underlying performance math. Now let's talk about the fee math, because this is where the active versus passive argument gets visceral. The average active ETF charges about 0.69% per year in expenses. The average passive ETF charges about 0.10%. That's a gap of 59 basis points. If that sounds abstract, let me make it concrete. You have a $100,000 portfolio earning an 8% gross return. Over 30 years, the passive investor who pays 10 basis points keeps essentially all of that growth. The active investor who pays 69 basis points loses roughly $200,000 to fees alone over that period. The active manager must outperform the index by enough to overcome that gap before they add a single dollar above what you would have gotten from the cheap index fund. $200,000. That's college tuition, a down payment, a decade of retirement income, eaten by fees. There is an argument that fees on active ETFs have come down. And that's true. Some active ETFs charge closer to 30 or 40 basis points, still higher than passive, but much more reasonable than the 1% or more that active mutual funds have traditionally charged. And in a few narrow corners of the market, active management has a defensible case. Small-cap stocks, for example. In 2024, only 29.7% of small-cap active managers underperformed their benchmark, far better than the 94% failure rate in large-cap. The theory is that smaller companies are less covered by Wall Street analysts, creating more pricing inefficiencies for skilled managers to exploit. The same logic applies in emerging markets and in some parts of fixed income, where opaque pricing and fragmented trading create pockets of inefficiency. If you're going to pay for active management, these are the places where the odds are least stacked against you. But for your large-cap US equity exposure, the core of most people's portfolios, the S&P 500, the total stock market, the data is merciless. You are almost certainly better off in the low-cost index fund. Morningstar's research on this is clear. Funds in the cheapest quintile of fees succeeded more often than funds in the priciest quintile, 31% versus 17% over the 10-year period through 2025. Cost is the single most reliable predictor of future fund performance that we have. Not past returns, not manager pedigree, not strategy narrative, cost. And this brings us to the behavioral finance angle, because the active ETF surge is not just a tax story, it's a psychological one. Behavioral finance research has documented for decades that investors systematically make decisions that hurt their returns. Recency bias makes us overweight what just happened. When active ETFs are in the headlines every day, when 80% of new launches are active, when the narrative says active is back, our brains interpret that as a signal to act. The CFA Institute curriculum specifically classifies this as a cognitive error. Relying on the availability of recent information rather than the base rates of long-term data. Loss aversion compounds the problem. When the market is volatile, which it always is, loss-averse investors feel the pain of drawdowns roughly twice as acutely as they feel the pleasure of gains. That emotional asymmetry makes them want to do something, anything, to regain a sense of control. And active management sells control. Passive investing by its nature requires accepting that you cannot beat the market and that your only job is to capture it. That's hard. It feels passive, literally. And in 2026, with Iran war inflation, bond yields at 20-year highs, and a new Fed chair creating uncertainty, the temptation to seek control through active management is stronger than ever. But here's the truth that the research keeps confirming. Checking your portfolio less often leads to better outcomes. Benazzi and Thaler's work on myopic loss aversion shows that investors who check their portfolios daily take less risk and earn lower returns because they see losses more frequently and react emotionally. The investor who checks quarterly makes more rational decisions and earns more over time. Automation, automatic contributions, automatic rebalancing, automatic dividend reinvestment is the single most powerful tool most investors have, and it's free. So what does a practical portfolio look like in 2026? The framework that the data supports is a core satellite approach, 80 to 90% in low-cost broad market index ETFs, a total US stock market fund or an S&P 500 index fund, a total international stock fund, a total bond market fund, 3 funds, expense ratios near zero, no manager risk, no style drift, no capital gains distributions. Then, for the remaining 10 to 20%, the satellite piece, you can consider targeted active ETFs in areas where the data supports a case, a small cap value fund with a strong track record, an emerging market fund where market inefficiency is real, a fixed income fund run by a team that has historically navigated changing interest rate environments well. These aren't gambles. They're small, deliberate tilts in corners of the market where active management has historically had better odds. But here's the kicker. Even that 10 to 20% satellite allocation only works if you have the discipline to rebalance. Rebalancing forces you to sell what's gone up and buy what's gone down. It's deeply uncomfortable emotionally because you're trimming your winners to add to your losers. But it's the mechanism that makes the core satellite approach work. Without annual rebalancing, a good active fund can drift your portfolio out of alignment, and a bad one can compound losses without you noticing until years later. There's one more thing I want you to take away from this episode. The active versus passive debate has been going on for decades, and every few years, a new narrative emerges about why this time is different. In the 1990s, it was the dot-com stock pickers who were going to beat the market. In the 2000s, it was hedge funds. In the 2010s, it was factor investing. In the 2020s, it was active ETFs. The wrapper changes, the marketing changes, the fee structures evolve, but the underlying arithmetic does not. Most active managers, most of the time, do not beat the market after fees. That is not a temporary condition. It is a structural feature of how markets work. The 2026 active ETF surge is a real phenomenon. $459 billion in flows is not noise. But understanding what those flows represent, a tax-efficient migration of existing active believers, not a conversion of passive investors, is what separates informed investors from people chasing headlines. The same fee math that has ruled investing for 50 years still rules today. The same behavioral biases that have cost investors trillions still apply. And the same simple solution. Buy the whole market, hold it forever, keep costs low, check less often, still works. If you want a concrete framework to walk away with, here it is. First, identify your asset allocation based on your time horizon and risk tolerance, not on what the market did last month. Second, choose 3 to 5 broad market index ETFs that cover US stocks, international stocks, and bonds, VTI or IVV for the US, VXUS for international, BND or AGG for bonds. Third, set up automatic monthly contributions that buy regardless of price. Fourth, commit to a single annual rebalancing date. Your birthday, tax day, New Year's, it doesn't matter which, only that you stick to it. Fifth, and this is the hardest one, stop checking. Turn off push notifications from your brokerage app. Schedule a quarterly review instead of a daily scroll. Every time you check the market, you invite your amygdala to override your prefrontal cortex. The behavioral finance research is unambiguous on this point. Less frequency equals better outcomes. And if you want to add an active tilt, limit it to 10 to 20% of the portfolio. Put it in corners of the market where the data supports a case. A small cap value ETF run by a team with a documented process. An emerging market fund targeting countries with less analyst coverage. A multi-sector bond fund navigating the current yield curve environment. But make sure you can articulate why you're paying that fee before you write the check. If the answer is because this fund has performed well recently, that's recency bias talking, not a strategy. Core satellite if you want to be precise. Total market index funds as your foundation. A small active tilt where the data supports it if you have the discipline. Rebalance once a year. Automate everything else. That's not financial advice, it's just arithmetic. And in a world where 80% of new ETFs are active and the marketing machine is working overtime, arithmetic is your best friend. Thanks for watching. If this episode helped you think more clearly about your portfolio, share it with someone who's wondering whether to switch to active ETFs. The data doesn't change just because the wrapper does. And the more people understand that, the better off we all are.